Okay, let's be honest for a moment. For a lot of us, the word math, well, it can bring back some less than fond memories, right?
Yeah.
Maybe zoning out in class.
Yeah, maybe a bit of anxiety.
Exactly. And then applying that to real estate, something so, you know, people-focused. It can feel like extra pressure we don't need.
That's a really common feeling, absolutely. It often feels like, the numbers are this whole separate language you suddenly have to be fluent in.
But what if we flip that?
Mhm.
What if, instead of this, hurdle we dread, real estate math was actually your secret weapon? Like a kind of financial superpower that really changes how you operate day to day.
I love that framing. And that's really the core of what we're digging into today. We've pulled together a bunch of sources, guides, articles, some educational stuff, all about real estate math. And our mission here is to unpack the essentials. We want to show how getting comfortable with these numbers isn't just about, say, passing an exam. It's about building real confidence. It's about demonstrating solid expertise to your clients and honestly just bringing clarity to the financial side of transactions for everyone involved.
Absolutely. Think of it as like cutting through the static to get to what really matters financially in the deal. We're not diving into, complex calculus or anything.
No, definitely not.
This is about the practical everyday math. Stuff like calculating commissions your own earnings.
Crucial.
Figuring out prorations at closing so costs are divided fairly.
Yep.
And just understanding some key formulas for loans, maybe even some basics for investment analysis. It's about making numbers work for you.
Let's do it. Let's unpack this financial superpower.
All right, so where do we begin? I think for most agents, what's really top of mind is, well, how they get paid, right?
Understandably, yes.
So let's tackle calculating commissions first. Knowing your earning power feels pretty fundamental.
It absolutely is. And the basic idea, when you look at the sources, it's actually pretty straightforward once you break it down. Commission is basically just a part of the whole, which is the sale price. And that part is determined by the rate, the percentage.
Part whole rate, okay.
Yeah.
And I saw one source mentioned a neat little visual for this, the T-bar method. I like simple tools like that.
Me too. It's surprisingly effective. Just picture drawing a big letter T.
Okay.
In the top section of the T, you put the part. That's the actual commission amount, the dollars.
Got it. Top is the amount.
Then on the bottom left, you put the whole, that's the total sale price of the property.
Okay.
And bottom right is the rate, the commission percentage.
Right. T-bar. Part on top, whole, and rate on the bottom. So how does it help?
Well, it visually shows the math. If you don't know the commission amount, you cover that top section with your finger. And you see you need to multiply the two bottom parts, whole sale price times rate percent.
Okay. Whole times rate gives you the part.
Exactly. Now, what if you know the commission amount, the part, and the sale price, the whole, but you need to find the rate?
Let's see. Cover the rate. Looks like part divided by whole.
You got it. Part divided by whole gives you the rate.
And the last way, if you know the commission you want to earn, part, and your rate, and you want to figure out the total sales needed whole.
Same logic. Cover the whole. You're left with part divided by rate.
Part divided by rate tells you the whole sales volume. Simple.
It is. And there's a little practical tip from one source, something that can trip people up sometimes. When you're doing the division part, whether it's part whole or part rate, always punch the part number into your calculator first.
Oh, good tip. Like literally the number on top of the T-bar goes in first when dividing.
Right. Avoids calculation errors.
Okay, let's use an example from the sources to make this real. Say a $165,000 sale price, and the commission rate is 7.5%. We want the commission amount.
Okay, so that's the part we're missing. Using the T-bar, we multiply the whole, $165,000, by the rate, 7.5% or 0.075 as a decimal.
$165,000 times 0.075 comes out to $12,375.
Exactly. That's your commission, the part.
Straightforward enough. Now, what if it was the other way around? You knew you made $12,375 on a $165,000 sale, but maybe you forgot the exact rate you'd negotiated.
Okay, so this time we know the part, $12,375, and the whole, $165,000. We need the rate.
So part divided by whole.
Right. $12,375 divided by $165,000. Put the $12,375 in the calculator first.
Gives you 0.075.
Which is 7.5%.
Yeah.
See, the T-bar keeps it organized.
Well, that's the basic commission calc. But where it gets maybe a bit more complex, but also more powerful, is with tiered commissions.
Yes, those are common.
One source had this example. An agent earns $85,000 total commission for the year. But their deal is structured like this: 4.5% on the first $500,000 sales, and then 6% on any sales above that $500,000 mark.
All right. So just knowing the basic formula isn't quite enough here. You need to work backwards, sort of step by step.
How would you approach that?
First, figure out how much commission came just from that first tier, the $500,000 volume at the 4.5% rate.
Okay, so $500,000 times 0.045. Let me grab my calculator. That's $22,500.
Correct. So $22,500 of their total $85,000 commission came from that initial $500K in sales.
Got it.
Now, the rest of the commission must have come from sales in the higher 6% tier.
Okay, so subtract that first bit. $85,000 total minus the $22,500 leaves $62,500.
Right. And that $62,500 was all earned at the higher 6% rate.
So now we use the T-bar again. We know the part $62,500 and the rate 6% or 0.06. We need the sales volume in the second tier.
Exactly. So part divided by rate, $62,500 divided by 0.06.
Okay, $62,500 divided by 0.06 is $1,041,667 roughly. Yeah. That's the sales volume achieved at the 6% rate.
Okay, but that's not the total sales volume for the year, is it?
No, exactly. Remember the structure: 4.5% on the first $500 and 6% on everything over that. So to get the total sales volume, you have to add the volume from both tiers together. The first $500,000 plus this $1,041,667.
Bingo, which gives you a total annual sales volume of
$1,541,667.
That's what it took to hit the $85,000 commission goal with that particular tiered structure.
Wow. Okay, that feels like a superpower. Because you're not just figuring out what you did earn, but you can use it to calculate what you need to do, to set real, achievable goals based on your commission plan.
Precisely. It turns an abstract goal into a concrete sales target.
And the sources do mention, other ways commissions can work: flat fees, different kinds of rates, trailer fees. But understanding that core percentage calculation seems vital for most deals.
It really is the foundation.
Okay, so that covers the earning side. But guiding clients means understanding the costs involved too, especially all the money changing hands at closing. Which brings us to prorations.
Yes, prorations, definitely a key part of the closing process.
Sounds a bit technical. What does it actually mean?
It's actually pretty logical. Proration just means dividing up costs, or sometimes benefits like rent, fairly over a specific time period.
Fair.
Yeah. It ensures that when the property changes hands, the buyer and seller only pay for the expenses or receive the income for the actual days they own the property during that period. It's about making sure nobody pays for a day they didn't own it.
Okay, a fair split based on ownership time. What kinds of things usually get prorated?
Well, the big ones are usually property taxes. Also, interest on loans if a buyer is assuming one. Rent if it's an income property and closing happens mid-month. HOA fees are common too. Sometimes utilities, though those are often just switched over.
Right.
And one source made a good point. Not every single expense is prorated in the same way. Think about, say, a one-time deep cleaning for a rental unit before the sale.
Yeah.
That's not really a cost that accrues daily like taxes do. So things like that usually aren't prorated across the whole year. It depends on the nature of the expense.
That makes sense. You wouldn't charge the buyer for cleaning that happened months ago. So, practically speaking, how do you calculate a proration? What's the math?
The basic method is, first, find the cost per day for whatever item you're prorating.
Ow.
You usually take the total cost for the period, like the annual property tax bill or the monthly HOA fee, and divide it by the number of days in that period.
Okay, so total cost divided by days gives you cost per day.
Right. Then you figure out how many days each party, buyer and seller, is responsible for within that period based on the closing date, and you multiply the daily rate by their respective number of days.
Got it. Daily rate times number of days. But how many days are in the period? I remember the sources mentioning different ways to count.
Yes, that's a key detail. Especially for taxes and loan interest, you'll see different conventions. Some places use a 360-day year, often called a banker's year. It seems every month has exactly 30 days, which simplifies the math a bit.
30 days per month, 12 months. 360.
Okay. Others use the actual 365 days in a year, or 366 in a leap year. You need to know which method is being used in that specific transaction to be accurate.
Right. The specific method matters. Let's walk through an example. The sources often use property taxes paid in arrears. What does that mean, first off?
Paid in arrears means the tax bill you receive covers a period that has already passed.
Yeah.
Like, you get a bill in November for the period from January 1st to December 31st of that same year. You're paying after the fact.
Okay. So if closing happens, say, June 30th, and taxes are paid in arrears for the full year, Who owes what?
In that case, the seller lived in the property and was responsible for the taxes from January 1st up to and including the closing date, June 30th.
Right, they owned it for that half of the year.
The buyer takes over responsibility starting the day after closing, July 1st.
So how does the money move at closing?
Since the buyer will eventually pay the entire tax bill when it comes due later, the seller needs to give the buyer the money for the seller's share. So on the settlement statement, the seller gets a debit they owe for their prorated share of the taxes, and the buyer gets a corresponding credit. They receive that amount.
Ah, so the seller essentially prepays the buyer for the seller's portion of the upcoming tax bill. Makes sense. What about the opposite scenario, taxes paid in advance?
Okay, so maybe the seller paid the full year's tax bill back in January, but now you're closing on June 30th.
The seller paid for the whole year, but only owned it for half.
Exactly. So now the buyer owes the seller for the portion of the year the buyer will own the property, July 1st to get 31st, because the seller already covered that cost.
So the debits and credits flip.
Pretty much. The seller would get a credit back for the taxes they prepaid for the buyer's period, and the buyer would have a debit showing they owe that amount to the seller at closing.
Okay. And I assume rental income, if it's collected up front for the month, works similarly if you close mid-month.
Yep, same principle. If the seller collected rent for the entire month on the 1st, but closing is on the 15th.
The seller needs to give the buyer the rent for the 16th through the end of the month.
Right. The seller credits the buyer for the portion of the rent covering the days the buyer will own the property that month.
This all clarifies how those debits and credits work on the settlement statement. It's all about who owes what to whom on closing day. Like a buyer's loan origination fee, that's money they owe. So it's a debit to the buyer.
Correct. And the amount of the buyer's new mortgage loan is a credit to the buyer because that's money coming in to help them buy the house.
And for the seller, paying off their existing mortgage is a big debit, right? Money they owe.
Usually their biggest debit. And that payoff amount typically isn't just the principal balance. It includes any unpaid interest accrued up to the closing date. And sometimes, depending on the loan, a prepayment penalty might be tacked on too.
So prorations and understanding debits credits. It's all about making sure that moment the keys change hands, the financial slate is wiped clean and divided accurately for that specific point in time.
You nailed it. It avoids arguments and confusion down the road.
Okay, great. Now let's zoom out a little bit again. Beyond commissions and prorations, what other math concepts are really valuable for agents, maybe especially when dealing with financing or investment properties?
Yeah, there are a few more concepts that really help you guide clients effectively, especially on the money side of things. Understanding how loans work is huge.
Like interest calculations.
Definitely. A really basic but important distinction is simple versus compound interest.
Okay.
Simple interest is calculated only on the original amount borrowed, the principal. Compound interest, which is what mortgages use, calculates interest on the principal plus any interest that's already built up but hasn't been paid yet.
Ah, the infamous interest on interest.
That's the one. And the effect, especially with a long-term loan like a 30-year mortgage, is significant. In the early years of the loan, a much larger chunk of your monthly payment goes just to cover the interest owed.
And less goes to paying down the actual loan balance.
Exactly. Very little goes to principal initially. Over time, as the balance slowly shrinks, the interest portion of the payment decreases and more starts going towards the principal. Understanding this helps explain to buyers why their loan balance doesn't seem to drop much in those first few years.
That's a good point.
Yeah.
And speaking of loans, LTV, loan-to-value ratio. Lenders talk about this constantly.
LTV is critical. It's simply the loan amount divided by the property's value, shown as a percentage. So if you borrow $80,000 on a $100,000 home, your LTV is 80%.
And why is it so important?
For lenders, it's a primary measure of risk. Lower LTV means the borrower has more skin in the game, a larger down payment.
Which usually means?
Better loan terms for the borrower, lower interest rate, typically.
And that 80% LTV threshold, why is that number always mentioned?
Because going above 80% LTV, meaning a down payment of less than 20%, almost always triggers the need for private mortgage insurance, or PMI.
Right, PMI. Extra cost.
Yep. It's an additional insurance premium added to the monthly payment, often around 0.5% to 1% of the loan amount annually. And it protects the lender if the borrower defaults, not the borrower.
And you pay that until?
Until your LTV drops down to 80%, either because you've paid down the principal enough or sometimes if the property value has increased significantly. It's a crucial factor in a buyer's total monthly housing expense.
Good to know. And another loan cost origination fees. The sources said those can vary a lot.
They really can, anywhere from maybe 1% up to potentially even 12% of the loan amount in some cases, though that higher end is less common for standard mortgages. But that fee directly impacts the net cash the borrower actually gets from the loan proceeds. It's another cost of borrowing to factor in.
And while calculating the exact remaining loan balance after each payment involves complex amortization schedules, which the sources detail using those 360 or 365-day methods, the key takeaway is why that principal balance goes down so slowly at the start because of compounding interest.
Precisely. Now, thinking about affordability for buyers, the sources mention some rules of thumb lenders often use.
Yeah, something like the 28-36 rule.
That's a common one. It's a guideline, not a hard rule, but lenders often look at it. It suggests your total housing costs, principal, interest, taxes, insurance, HOA fees, so PITI plus HOA, shouldn't be more than about 28% of your gross monthly income.
Okay, 28% for housing. What's the 36?
The 36% refers to your total debt obligations. That includes your housing costs plus other debts like car payments, student loans, credit card minimum payments. All that shouldn't exceed 36% of your gross monthly income.
So it's a quick check for lenders and a useful ballpark for clients wondering what they might qualify for.
Exactly. It helps set realistic expectations.
Okay, so that covers a lot of the math relevant for typical buyers and sellers. But what if you're working with investors? That feels like it requires another layer of calculations.
It definitely does. And mastering some basic investment analysis math is where you can provide huge value to those clients. It really elevates your service in that niche.
Like understanding terms such as NOI and cap rate, net operating income and capitalization rate.
Those are fundamental. Net operating income, or NOI, is basically the property's potential rental income minus vacancy allowances, minus all its operating expenses, things like property taxes, insurance, management fees, repairs, utilities paid by owner, etc.
So income minus operating costs. What does it not include?
Crucially, NOI is calculated before subtracting mortgage payments, debt service, and income taxes. It's a measure of the property's pure operational profitability independent of financing.
Got it. Property's performance on its own. And cap rate.
The cap rate, or capitalization rate, is calculated simply as NOI divided by the property's current market value or purchase price.
NOI value, what does that percentage tell you?
It gives you a snapshot of the potential rate of return on the property if you bought it with all cash.
Ah, assuming no loan.
Exactly. That's the key insight here. Cap rate is really useful for comparing the relative profitability of similar income properties in a market, assuming cash purchases. A higher cap rate generally suggests a higher return for the price, again, on a cash basis.
But most investors use loans, right? Leverage is common.
Absolutely. And that's the big limitation of relying only on cap rate, as the sources emphasize. It totally ignores the impact and cost of financing. If your client is getting a mortgage, the cap rate doesn't reflect their actual return on their invested cash.
So if cap rate isn't the full picture for leveraged investors, what else should they look at?
That's where cash-on-cash return becomes really important.
Okay, cash-on-cash return. How's that calculated?
You take the annual cash flow after paying the mortgage, so NOI minus the annual debt service payments, and you divide that by the actual amount of cash the investor put into the deal initially.
So the actual profit after mortgage divided by the down payment and closing costs.
Basically, yes. It measures the return specifically on the cash they took out of their pocket. It's a much more relevant metric for most investors because it reflects the performance of their invested capital, considering the leverage they used.
That makes a lot more sense for someone putting, say, 25% down. They want to know the return on that 25%.
Precisely. And one last piece, especially for rental properties, is understanding depreciation.
That sounds like a tax concept.
It is, and it's important. Depreciation is a non-cash expense, meaning no actual money leaves your account. But the IRS allows owners of investment properties to deduct a portion of the cost of the building, not the land, each year to account for wear and tear and obsolescence.
So it reduces their taxable income.
Exactly. For residential rental properties in the U.S., the standard method is straight-line depreciation over 27.5 years. You basically divide the building's value by 27.5 and deduct that amount each year.
Can an owner just decide not to take that deduction?
Interestingly, the sources point out that it's essentially mandatory from the IRS's perspective. Even if you don't claim it on your tax return year to year, when you eventually sell the property, The IRS will calculate the taxes owed based on the assumption that you did take the allowable depreciation. This is called depreciation recapture.
Wow. Okay. So you really need to understand it, even if it seems like just a paper deduction.
Absolutely. If you're advising investor clients, understanding how depreciation impacts their taxes and eventual sale proceeds is key.
Man, we've covered a lot of ground with numbers today, from commissions
Yep, calculating your pay, including those tricky tiered
to
ones,
prorations,
making sure everything's split fairly at closing taxes, rent, HOA fees,
understanding loan math,
like LTV, compound interest, PMI, those affordability rules.
and even dipping into investment metrics.
Right. NOI, cap rate, cash on cash return, and that depreciation piece.
It really is a toolkit.
It is. And I think the big takeaway looking across all these sources is that none of this math is beyond reach. It's not theoretical physics. It's practical step-by-step stuff that you can absolutely learn and get comfortable with.
It's not about needing to be some kind of math genius. It's just about building fluency with the numbers that are part of your everyday business.
And when you have that fluency, that comfort, well, it translates directly into confidence.
Yeah, I can see that.
When you can clearly explain how a commission split works, or walk a client through the prorations on their closing statement without stumbling, or talk intelligently about LTV and what PMI means for their payment, that demonstrates real expertise.
You build trust. You can answer questions accurately, represent costs clearly, maybe give investors a realistic ballpark figure, troubleshoot issues that pop up.
It takes abstract financial stuff and makes it concrete and understandable for your clients. It really is like having that financial superpower in your pocket.
Absolutely. So maybe the final thought for everyone listening is this. How could developing this comfort, this capability with numbers, change how you approach things?
Right. It's not just about being more reliable in the moment, but how might it fundamentally shift the way you evaluate deals, advise clients, and even spot opportunities? What could you unlock by seeing real estate through a more confident, quantitative lens?